Let's have a discussion about the circle of knowledge. And specifically, let's talk about the universe of your financial knowledge. This circle right here on the screen represents your or the complete universe of financial knowledge. And there's certain things financially that you absolutely think you know to be true. There's no arguing it. There's no trying to change your mind otherwise. You absolutely believe that these things are true. And then there's other things that you know exist, but you do not know how they work. So to go a little bit of psychology 101, what you know to be true, we can call your conscious competence. What you know exists, but you don't know about because you haven't done anything about it is what we call your conscious incompetence. And then there's the slice of the pie, the universe of knowledge that is your financial blind spot. You don't know about it. You don't know it exists. You've never heard about it. So that would be called your unconscious incompetence. So a couple questions. Remember, this is strictly focused on finances. And there's really only three ways that you can expand your universe of knowledge. One of those is you can experience things, you can do things. Obviously, financially, you're not going to go places, but we could change that to things that you've done, you've experienced, you've invested in them, you've tried them in the past, you know about them. Or you can read up on them. The second way you can learn or expand your universe of knowledge financially is you can read up on things or you can study them. And then the third way is you can have someone transfer that knowledge to you. I'll give you another example. Most people that are entrepreneurs, business owners, do not do their own taxes. They hire a CPA or a tax advisory firm or a tax lawyer or a tax attorney to do their taxes for them. So that person transfers that knowledge to you via the fee that you pay them. And you also do this with your investment advisor, your financial planner, your certified financial planner. So that's not uncommon, right? So you can experience things, you can study up on them yourself, or you can have someone transfer that knowledge to you. Maybe I could be that person that transfers knowledge to you about how life insurance as an asset really works, how high net worth individuals use that asset class. But my question is what if, entertain the possibility for just a second. What if what you thought you knew to be true ended up being untrue? If that were the case, how fast would you want to know it? Like immediately, right? That's the question at hand. Do you really know what you think you know to be true when it comes to finances, when it comes to vehicles, when it comes to how money really works? And let's just take a simple quiz. Now, you're going to have to play along at home because I can't get your answers real time like this, but I do know when I've done this with clients before, it's way off. So let's talk about the income game. And how much does your household income need to be in order to be in the top 50, 25, 10, 5, and 1% of income earners all across the United States? So right now, think of a number. What do you think your household income needs to be to make it into the top 50% of income earners in the United States? You got it? You got a number? What's the number? I bet it wasn't $42,000 to be in the top 50% of income earners. I bet your number was substantially higher than that, okay? Well, what do you think your number needs to be into the top 25% of income earners in the United States? You have a number? 85,000. Almost twice as much. Okay, well, let's keep playing the game. Do you think it's twice as much to be in the top 10% of income earners in the United States? What do you think the number is to be top 10% household adjusted gross income in the United States? Got a number? 152,000. Okay, top 5%. So now we're getting to the upper echelon of income earners in the United States. What do you think the household income combined AGI needs to be in the top 5% of income earners in the United States? Got a number? $220,000. Was your number a lot higher than that? I bet it was. Okay, top 1%. Those dirty 1%ers, the ones that aren't covering their fair share of taxes. And we're going to get to that here in a second. But what do you think the household income needs to be to be in the top 1% of income earners in the United States? You have your number? All right, $548,000. I bet your number was a lot higher. The majority of families and high net worth individuals that I talk to think that needs to be in the millions and millions of dollars to be in the top 1% of income earners. Isn't that crazy? Now, that's a substantial income. but it's probably not as high as you thought it was. Let me put it another way. To be the top 50% income earners carried 98% of the tax load for the rest of the country. Put it another way, the bottom 50% income earners in the United States only covered 2% of the entire revenue. And if you hadn't watched my video on the problem that we're facing right now, why taxes are going to be going up, you need to watch my old video or my last video here or here. I never know where the link is going to pop up, but watch this video where I talk about the US debt clock. And I talk about, I think the number was, the deficit was like $7 trillion, $7.5 trillion that the US is spending on an annual basis and only making like $4.7 trillion of income. So there was a $1.8 trillion gap, but that $4.7 trillion comes from everybody on this screen. Only 2% comes from the bottom 50%. Think about that. So the top 25% income earners carried 88% of the tax liability. The top 10% making $152,000 a year of the AGI covered 73% of the taxes. The top 5% cover 62% of the taxes. Now look, the top 1% income earners, the dirty 1% that don't, what's the word that they used? They're not carrying their fair share. They're not covering the burden for everybody else. I beg to differ, because they cover nearly 42% of the entire tax revenue for the entire country of $4.7 trillion. The top 1% are paying 42% of the taxes. The top 50% are paying 98% of the taxes. There's 350 million citizens in the United States. I think of that, only about 150 million are taxpayers. So 75 million people, 25% of the entire population of the United States, are covering 98% of the taxes. The top 1% are covering 42% of the taxes. Why is this important? Because if you followed my last video, and if you haven't, go back and watch it, taxes have nowhere to go but up. And you, as a high net worth individual, you have to find alternative solutions to where you're putting your money, because the government is smart. They're patient and smart. I know they're smart, right? But they're smart on certain things. And when it comes to taxing you on your investments, they give you the choice. Would you rather be taxed on the seeds, or would you rather be taxed on the harvest? If you're gonna have to give the government a percentage of one or the other, would you rather give them 20, 25, 30, 35, 40% of the seeds, or 25 to 40% of the entire harvest? And I would argue that you wanna give them the seeds, not the harvest. Now, I wanna take you to another one real quick in this video, and this is all relevant, but we've talked about, and this is why life insurance is such an important asset class, because in my last video, I talked about how life insurance can be used with unstructured loan repayments, guaranteed loan availability, guaranteed collateral options, safe, guaranteed, doesn't lose value. When structured correctly, right? You have your minimum level that's set of premium for life insurance that's set by the life insurance industry. That's called term insurance premium. And then you have your maximum level of premium for a life insurance policy, which is set by the US government, called a modified endowment contract, or just underneath that, which is a maximum efficient contract. But why is that vehicle so important? Because it becomes a bank. It becomes your bank. It becomes an instrument that you can detach, or you can separate yourself from the banking institutions and not become reliant upon their money. So Dave Ramsey's out there saying, don't borrow money. If you can't afford something, don't borrow money. And I don't necessarily disagree with that. If you don't have money, you probably shouldn't be borrowing money. Now, you got to borrow money to get things going and build things up, but this conversation is not for people that don't have money. This conversation is for people that do have assets. In fact, I just got off a phone call with a client that is entering into a premium finance transaction with us. And he says, John, I don't borrow any money. The only place I'm borrowing money is for this life insurance policy. But that's because, John, you educated us on the power of using other people's money, the power of proper leverage. And remember, there's 7 caveats to a proper IUL structure. And that's yet another video here or here that I'll point you to, that you need to watch the 7 caveats of how to properly structure an IUL. But let's talk about borrowing money. Everybody says borrowing money is bad, and here's why they say it. So let's say you're gonna borrow $100,000, and you're gonna borrow $100,000 for 10 years, and the loan rate that they were gonna charge you is 6%. flat level 6%, not a floating rate, not a variable rate, but a flat 6%. Just stay with me, right? $100,000, borrowing $100,000. Now, what are you going to use that money for? That's also important. Are you investing in an appreciating asset, or are you investing that in a depreciating asset? All of that makes a difference. But for this context, let's just say you're borrowing $100,000 and that money is all of a sudden going to vanish. Well, 6% on $100,000 over a 10-year amortization schedule means $1,110 per month in a payment. And that payment would not only pay back the principal, but it would also pay back $33,225 of interest. And that's why everybody says borrowing money is bad, because you're paying interest to somebody else. But here's my question. If you're not borrowing money from someone else and you're paying cash, there's an opportunity cost to taking that cash out and paying cash for that thing instead of borrowing money. So let's assume you also have $100,000. At the same time that you're borrowing $100,000 at 6%, let's say you're gonna leave your $100,000 to earn 6% over that same 10-year period of time. And this is the power of compounding interest. I think Albert Einstein is famous saying that one of the wonders of the world is the power of compounding interest, because $100,000 invested today at 6% for 10 years would end up earning $81,000, almost $82,000 of interest over that 10-year period of time. Now, here's my question. If you have $100,000 and you paid cash for an asset, assuming that asset doesn't grow, that purchase would have cost you $81,000 of lost opportunity cost. But when you put the two of them together, and it's not an either or conversation, it's an and conversation. It's borrowing money and investing money at the same interest rate. The $100,000 left compounding over a 10-year period of time earns $81,000, but you collateralized your assets and you borrowed $100,000 of somebody else's money at the same 6%, you would have paid $33,000 of interest. But the difference between the two, $81,000 minus $33,000, $81,000 of interest earned minus $33,000 of interest paid, is still $48,000 of positive interest. And you can do this inside of a properly structured life insurance policy. This is how we get a banking structure built for you so that you do not have to rely upon banks to loan you money at their rates and at their terms. This is how you can set it up to borrow money at your rates and at your terms. And by the way, this is borrowing at 6 and earning at 6. We have structures and policies available to us where the maximum they can charge you to borrow the money is 5%. And we have uncapped interest crediting potential, which historically, they're over the last 15, 20, 25 years, they're at 7, 8, 9% interest earning compared to borrowing money at 5%. Think about how this graph changes when you're earning even more interest than the cost of borrowing. That is the proper use of leverage. That's the proper structure for life insurance when you build it the right way and you're funding it to the maximum limit. Remember, if what you thought you knew to be true ended up being untrue, how fast would you want to know it, and how fast would you act on making a difference? I'll see you in the next video. Like, comment, share, subscribe. Thank you.